Hi, good morning, everyone, and thank you so much for joining us here today. My name is 𝗲𝘃. I'm part of the research team at iFAST, and today, the main focus of my presentation is really on the market outlook for the year ahead and how investors should position their portfolios in 2024. Now, some of you may have noticed that I actually used the word recession in my presentation topic, and perhaps wondering if there was actually any typo errors in my slides, because the US economy has been incredibly resilient in 2023. What kind of recession are you talking about? Well, there actually is no typo errors on my slides. I'm telling everyone here that the US has already undergone a recession in 2023. But this recession is not your typical full-blown recession where every single part of the economy is doing badly all at the same time. This recession that I'm talking about, it's a new kind of recession, and it is what we call a rolling recession. So the US economy is already in a rolling recession. And what exactly is a rolling recession? A rolling recession is when different sectors of the economy experiencing downturns at different times. So you have certain sectors in the economy that are currently not doing so well, undergoing a recession, but yet at the same time, there are also other sectors that are doing well and helping to compensate for these pockets of weaknesses in the US economy. So as a whole, the US economy, even with all these pockets of weaknesses, as a whole, the US economy has been relatively resilient. Now, if you think about the sequence of events over the past few years, if you think back to 2020, when the COVID-19 pandemic first struck the US economy, the first sector that went into a recession was actually the travel industry. And then fast forward to 2022, when the Federal Reserve started to hike its interest rates, the next sector that went into a recession was actually the housing sector, because mortgage rates started to increase very sharply. And then, as we started to open up from the pandemic lockdowns, all that consumer spending on physical goods suddenly shifted to spending on services. And this is also when the next sector, which is the manufacturing sector, started to experience a contraction. The semiconductors was also a sector that suffered quite immensely because all that COVID-19 spending on physical goods suddenly dropped off in a big way. And that caused a sharp downturn in global semiconductor sales. And after semiconductors, there was also the tech industry, and I think it actually made the news headlines because there was a lot of mass layoffs in the tech industry, and there was a lot of cost-cutting initiatives that is widely implemented across the sector. Now, the interesting thing about all these downturns is that they all took place at different times. Okay, so for example, when travel industry was experiencing a recession, the housing industry was actually still doing okay. And then when the housing industry started its downturn, the travel industry has started to rebound again. When the semiconductors industry started its downturn, the housing industry started its rebound and contributed to economic growth in the US. So why is this important? It is important because if there is going to be a rolling recession, it means that there is going to be a rolling recovery. There is going to be a rolling recovery. And the pockets of opportunities in the stock markets are actually in those industries that have already undergone a recession. The important question then is, which are these industries that have undergone a recession and are about to recover strongly in the year ahead? There are two sectors that we think have undergone a recession and are showing signs of a strong recovery. One of them is actually the digital economy. So as I've highlighted just now, the digital economy has already undergone a recession, as shown by the mass layoffs and all the cost-cutting measures that have been implemented across the industry. And I think another sign of a recession within the industry, if I can just point you to the chart on the left, okay, you can see that earnings have been declining for consecutive quarters. So this is another sign that the tech industry actually hasn't been in a good place for the past year. But the good news for investors is that the sector is now showing signs of a strong recovery. And why do we say so? Number one, the massive layoffs that has taken place over the past year, they have slowed significantly. And all the cost-cutting measures that the tech companies have implemented, they are now starting to bear fruit. Because if you look at, if you go back to the chart on the left, the earnings growth of technology company has started to pick up in a big way. And earnings have likely bottomed in the first quarter of 2023, and they have started to pick up, and they have came in better than expected in recent quarters. Now, second thing also, I think is a very important point, is that tech companies, they are now starting to increase their capital spending. So from a cost-cutting mode, they are now shifting their focus to investing in the future in areas like artificial intelligence, in areas like cloud computing. And this is important because companies don't invest in the future if they don't expect the demand to be there. Okay, which also means that the tech companies themselves, they are fairly optimistic about their business prospects, and they are starting to invest in the future in anticipation of greater demand in the years ahead. And that could also translate to higher profits in the years ahead for the technology sector. Now, within the digital economy, we have a slight preference for the big tech companies. And we like big tech companies not just because they have very strong competitive advantages, very solid business models, but one thing that we really like about big tech is that they have solid balance sheets. Now, if you look at the chart on the right, okay, which shows you the total amount of cash that is being collectively held by S&P 500 companies. Okay, this amount of cash pile that is being held by S&P 500 companies is currently at $2.1 trillion US. Okay, it's a lot of money. S&P 500 companies, they have a lot of money. But the interesting thing here is that a quarter of this 2.1 trillion, about 25% of this 2.1 trillion, is held by the top 5 companies. And these top 5 companies happen to be big tech companies, which means the big tech companies have lots of cash on their balance sheets. And cash is very helpful, especially in this current environment. Cash can allow you to do R&D, make acquisitions, and especially for the tech sector, cash is important because it allows them to hire the best talent in the industry. So they have so much cash that there is actually no need for these big tech companies to borrow at the current high interest rate level. So it doesn't matter whether the Fed is going to cut interest rates or not. Okay? Big tech companies have the cash to grow in the years ahead. So digital economy is one sector that is going to recover. The second sector that will recover is the semiconductor industry, which also has undergone a period of a recession because the COVID period demand for electronic devices has dropped off in a big way as the world started to open up. And that has actually caused a huge profit drop in many semiconductor companies. But again, there are signs of a recovery. Okay, because if you look at the global semiconductor sales, the chart on the left, global semiconductor sales have been rising for consecutive months since last year. And we expect this recovery to continue because of the AI revolution. And this is when I bring your attention to the chart on the right, which shows you the quarterly semiconductor sales growth. And I've also indicated the periods of the previous revolutions, such as the PC, internet, and the smartphone revolution. Now, if you look at this chart, you will see very clearly that the start of every revolution in the past has always resulted in massive demand for semiconductors in the following years. The start of the PC revolution, internet, and smartphone, you can see that there were sharp spikes in the quarterly semiconductor sales growth. And we are now at the start of the AI revolution. So if this revolution continues, then what is going to happen is that there is going to be a sharp spike in semiconductor demand in the years ahead, just like the previous revolutions. And based on our own internal estimates, our forecast is actually for quarterly sales growth to hit 40% year-on-year by the second quarter of 2025. So this recovery story is not just a 2024 story. Okay? It continues into the early parts of 2025. So there is still a long runway of growth for the semiconductor industry. So with an expected recovery in the semiconductor and the digital economy, so I think what that means for the US economy is that it is going to be resilient. As I said, there is a rolling recession happening in the US. Its economy is highly diversified, which means that that there may be some sectors that undergo a contraction this year, but there will be other sectors like semicons and digital economy that will come in to help pick up the slack that is left behind by these pockets of weaknesses. The macro data also supports our view of a resilient US economy. because the labor market is still extremely strong at this point. Unemployment rate is at record low levels. Wage growth is still above average. And consumers in general, they are still fairly confident about their finances and job prospects. So if you look at the chart on the left, okay, which shows you the number of job openings per unemployed person. So right now, in the US economy, for every unemployed person, there are currently about 1.5 job openings. So yes, there has been a slowdown in hiring activity. So this number has actually declined from the peak in 2022. But relative to pre-pandemic levels, you can see it is still significantly higher. The jobs market is still very tight relative to pre-pandemic levels. So there is still a significant gap between labor supply and the number of available jobs in the US economy. Household savings, okay, if you look at the chart on the right, household savings, yes, it has been coming down because consumers, they have been drawing down their pandemic savings. But again, relative to pre-pandemic levels, households are still sitting on lots of savings that will provide a cushion for the US economy. And importantly, people have jobs. People have jobs that pay them at above average wage growth, which also means that there is actually a less need for them to draw down their savings. So consumers are spending, the government is also spending lots of money. The US government is running record budget deficits on policies like the Inflation Reduction Act, the CHIPS and Science Act, and all these things are going to help keep the US economy resilient. So I think a full-blown recession for the US economy is not something we're expecting to happen this year. And with the economy expected to be resilient, I think what that means for inflation is that I think inflation is unlikely going to hit 2% or close to 2% within such a short period. I think the consensus now is actually for inflation to hit 2% in 2024, and that will actually allow the Fed to cut interest rates this year. So the Fed is currently forecasting 3 rate cuts this year, and markets have gone even further to price in 6 rate cuts in 2024. We actually disagree with this view. We actually don't think the Fed will cut interest rates aggressively this year because we think that it is very difficult for inflation to hit 2%, and our base case is actually for the Fed to hold interest rates this year. Okay, I know I know this sounds like we are on a different planet when we say the Fed is going to hold interest rates, but we have this view because there is still a great deal of uncertainty surrounding the trajectory of inflation. So as I said just now, the labor market at this point is still very strong. Wage growth is still too fast to be consistent with 2% inflation. Okay, inflation is something that will come down if economic activity slows. But if consumers, if the government is spending so much money, then it will actually provide, provide an upward pressure on inflation in the US. And also inflation is something that comes in waves. It is not something that comes down in a straight line. Okay, as you can see from the inflationary periods of the 1960s and the 1980s, which I've shown on this chart here. So you can see very clearly that inflation has several peaks and bottoms. So every time when you think that inflation is finally coming down, it goes back up again because of unforeseen circumstances. And this is very true of this current inflationary period of the past few years. If you can recall, at the start, inflation was due to all the supply chain disruptions. And at that point, the Fed said that inflation was going to be transitory. Once all these supply chain disruptions are being resolved, inflation is going to come down. But did it come down? It didn't, because the next inflationary driver was actually from the services sector, because consumers started going out to spend on entertainment, restaurants, and travel. So inflation came from the services sector. And then all of a sudden, you have the Russia-Ukraine war, which was again unexpected, and that drove up commodity prices. And then when commodity prices started to come down, I think in the middle of last year, we had a sudden spike in oil prices towards $100 a barrel. And now the oil prices are coming down. Now that inflation is finally showing signs of cooling, everyone thinks that, oh, inflation is finally defeated. Now we have the Middle East conflict that is brewing. We don't know if that is going to escalate, but if it does, then that's going to be the next inflationary driver. It will drive up oil prices. It will also drive up inflation because your supply chains are going to be disrupted by all that attacks on the Red Sea. So it's still a great source of uncertainty for inflation, which is why we find it very hard to rationalize that the Fed will definitely cut interest rates aggressively this year, given the uncertainties of the direction of inflation. So our base case is no rate cuts this year, and you also have an economy that is very resilient. If the Fed cuts rates this year at a time when the economy is doing well, then that is going to push up inflation once again. Okay, but even if we are wrong, even if the Fed does cut interest rates in 2024, it will also likely not be aggressive, definitely not the 6 interest rate cuts that markets are expecting this year. So I think our key message is that interest rates are higher for longer. It will definitely stay higher than the levels before the Fed started its tightening in March 2022. There is no way we're going back to the easy monetary policies of the decade. And the implication for investors in this higher for longer interest rate environment is, I think, firstly, for them to stay in short duration bonds for fixed income. And also, number 2, within equities, I think it's important to invest in quality companies and also consider having a bit of commodity-related exposures within your portfolios. Well, outside of the US, we also see pockets of opportunities in certain geographical markets. And one of the markets that we are positive on in 2024 is actually Japan, because we believe that Japan's economy is currently at a turning point. So I think we may all know that Japan has been suffering from chronic deflation for the past 30 years. Wages have also been stagnant. So in Singapore, at the end of every year, I think there is a certain kind of expectation that we expect our salaries to be adjusted upwards by a certain amount to account for the impact of inflation. But in Japan, the situation is so different. A generation of workers have barely gotten a pay raise throughout their 20 to 30 years of working lives because of the chronic deflation. So consumers, seeing that prices are low and falling, and seeing that their wages are not growing at all, consumers have been unwilling to spend in the Japanese economy. Businesses are also stuck in a deflationary mindset because they are afraid of raising prices. They are afraid of losing customers. If you raise prices over the past 20 to 30 years, you have to go on national TV and you apologize to the whole nation. This is how the mentality is in Japan. People don't want to raise prices. And of course, consumers are not spending. If the businesses see that consumers are not spending, the demand is not there, then definitely they are not going to invest their monies in the future because the demand is not going to be there. So instead of investing, businesses in Japan, they are hoarding cash on their balance sheets for the past 20 to 30 years. But all of this is changing because, like I said, I think Japan's economy is currently at a turning point. Take inflation, for example. Inflation is now starting to pick up after many years of deflation or low inflation. So inflation is currently it's at its highest level in more than 30 years. And it has also been above the central bank's 2% target for 20 consecutive months. So this is the longest period where inflation has stayed above the central bank's target. And Japanese companies, they are also now more comfortable raising prices because if the price of everything else is rising in the economy, then of course you have an excuse to tell your consumers that, hey, everything else is rising. I also need to raise my price. So businesses, they are also more comfortable raising their prices. Importantly, wages in Japan is finally picking up. They are finally getting their pay raise. So if this high inflation, if this wage growth sustains, this will be a golden opportunity for Japan to finally break free from its deflationary cycle because there will be a reset in price and wage expectations. So for consumers, if they see that prices are on the rise, if they also expect their wages to go up as well, then they will start to spend. Businesses, seeing that consumers are starting to spend and anticipating that there will probably be future demand in the years ahead, they will also now start to invest the huge amounts of cash that have been sitting on their balance sheets for the past 20 to 30 years. And of course, when businesses do well, that translates into better wages for workers, and which will in turn stimulate more consumption in the economy. So this creates a positive cycle that will allow Japan to finally break free from its deflation. And of course, if that happens, then there will be major positive implications for earnings and share prices for Japanese companies. Now, besides Japan, I think we're also quite positive on several export-oriented Asian economies. because we think that the upswing in semiconductor demand is expected to have positive repercussions on some of these economies, particularly South Korea and Taiwan, because these two markets are especially sensitive to the semiconductor cycle. So take South Korea, for example. 40% of its economy is made up of exports. And semiconductors is its #1 export for the past 7 years. So if you want to benefit from this upswing in semiconductor demand, then South Korea is the place that you want to be in. The other market that you should consider is Taiwan. Taiwan is arguably even more sensitive to the semiconductor cycle compared to South Korea, because 70% of Taiwan's economy is made up of exports, and semiconductors make up a big part of their overall exports. And then you also have companies like TSMC that basically controls a big part of the global semiconductor market right now. So I think Taiwan is also a place that you can consider putting your monies in. Although I must say at this point that between South Korea and Taiwan, we do have a slight preference for South Korea, because Taiwan does come with an added element of geopolitical risk, given China's very aggressive stance on reunification and the possibility of a military confrontation for Taiwan. It's low, but it's still a very real risk for Taiwan equities. Singapore and also our neighbor Malaysia, they will also be amongst the beneficiaries, because both of our countries are also, we play significant roles in the global semiconductor supply chain. And if you think about some of the major semiconductor companies out there, like TSMC, NVIDIA, so these companies, they are mainly involved in the upstream and midstream semiconductor supply chain, such as the design and manufacturing of semiconductor chips. Singapore and Malaysia, on the other hand, we're more involved in the downstream operations, which includes the assembly, the packaging, and also the testing of semiconductors. So with an expected upswing in semiconductor demand, then of course Singapore and Malaysia will also be amongst the beneficiaries as well. But I'd like to just put a spotlight on Singapore, not just because it's our home market, also not just because it's expected to benefit from a semiconductor upcycle, but the reason why I want to put a spotlight on Singapore is because Singapore is in a unique position. Singapore will also benefit from the shifting geopolitics between the US and China. We have already seen an influx of foreign direct investments, with companies increasingly choosing Singapore as the place to set up their regional quarters. Regional wealth is also flowing in, and foreign talent is also coming in as well. Singapore is also now the top financial hub in Asia. And we also have a government, a competent government that is proactively attracting foreign investments, promoting free trade, and also we have quite a stable business environment. Which is why Singapore, increasingly, we are now serving as the bridge between the East and the West. And we will stand to benefit from the opportunities that will be created by the shifting geopolitics between the US and China. And the bonus right now for Singapore is that we're going to have an anticipated rebound in trade numbers. And because of that, we're actually quite fairly positive on the economic prospects of the Singapore economy in the year ahead. And we expect Singapore's GDP to expand by 4% in 2024. If there's one economy that you should avoid, it is China. Okay? China's economy is in a terrible shape. And it's not supposed to be like this, because 2023 was supposed to be a comeback year for China equities because they basically removed their zero COVID policy. But what investors got at the end of the year was a weak economy that is struggling with deflation, and also a stock market that massively underperformed the US equity market. So with China's economy and stock market currently at rock bottom levels, I think the question that most people have is this now the time to finally go into Chinese equities? Our answer to that is actually a no, for a few reasons. China's economy badly needs stimulus at this point, but the government has been reluctant to deliver stimulus. Why? Because they are unable to. They are unable to because local governments are struggling with a heavy debt burden. Local governments have been taking on huge amounts of debt over the years to fund infrastructure investment and the pandemic control measures. In normal times, that wouldn't have been a big issue because the local governments, even though they have taken on debt, okay, they still bring in sizable revenues from land sales. So in normal times, it's actually not a big issue. But times are obviously not normal in China because the government has cracked down big time on the property market, which means that all that land sales has, in fact, dried up. And a critical revenue source for all these local governments have disappeared. But the debts didn't disappear. It's still on their balance sheets, which means that the local governments, they are now struggling to service their debt obligations. So against this backdrop, the government has been very reluctant to do stimulus because that is going to encourage local governments to take on even more debt and potentially destabilizing the financial system. So they have been reluctant to do that. Number two, China is suffering from a confidence crisis. And once you lose confidence in something, it's very hard to get it back. So even if China is able to do large-scale stimulus, even if they are able to loosen their purse strings to inject stimulus into the economy, there is no guarantee it will work because consumer and business confidence is still at very fragile levels. And adding on to that is also longer-term concerns over China's embrace of a top-down state-controlled growth model, because that is going to lead to a period of low growth and also affects the long-term profitability of private companies. The risk of policy mistakes will also be higher. And we also have rising US-China tensions. So that also is going to be an overhang on the economic prospects of China in the future. Okay. Another thing, one thing that I'd like to just point out for equity markets is that equity markets, even though there are selected opportunities, okay, they are not trading at bargain prices at this point. They are not screaming buys at this point. So diversification at this point, it still remains an important element in any portfolios. So investors should not forget about fixed income, because fixed income, there are still opportunities within the fixed income space. Okay, my time is running out, but I'll just bring your attention to our views within fixed income. So if you want to invest in a particular segment in fixed income, okay, that particular segment will be short duration bonds. And that is because of our view that inflation will be persistently high, and our base case is actually for the Fed to hold interest rates in 2024. And the bonus for short duration bonds is that they are offering quite attractive yields of around 5%. And these are not your high yield bonds. These are your investment grade, short duration bonds, and money market instruments. So 5% yield for minimal risk. I think that's a very attractive segment to consider putting your monies in. So if you're looking for a place to diversify your equity exposure, I think incorporating some fixed income assets, particularly short duration bonds, inside your portfolios is a good idea. Okay, so this is my last slide, just a summary of everything that I've said today. So I think the key point is, number one, we are neutral on equities relative to fixed income. We see opportunities in both asset classes. Within fixed income, we are positive on short duration bonds. And within the equity markets, we are positive on the digital economy, semiconductors, and also related to the semiconductor upcycle is South Korea, Japan's economy at a turning point, Singapore as well. Taiwan, Malaysia has also been highlighted. Brazil is on this list because we are also fairly positive on the outlook for commodities. And on the other end of the spectrum, in terms of markets that are unattractive, it is China, and Hong Kong is also there because, you know, if you look at the Hang Seng Index, a large majority of the stock index is actually in Chinese companies. Okay, so with that, I wrap up my presentation. Thank you so much for your time.